Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Esco Technologies Inc. quarterly report. Esco Technologies Inc. offers a diverse range of businesses and services to various industries. In the aerospace and defense sector, the company provides engineered components and systems, including specialty filtration products, miniature electro-explosive devices, mission-critical bushings, pins, sleeves, and precision-tolerance machine components. In addition to these offerings, ESCO also designs and manufactures elastomeric-based signature reduction solutions for naval vessels. Furthermore, it provides mission-critical signature and power management solutions for the aerospace and defense industries. The company's Utility Solutions Group segment focuses on developing diagnostic testing solutions and decision support tools for the renewable energy industry, primarily wind and solar. This segment caters to the needs of customers in the utility sector by providing innovative solutions for their operations. ESCO's RF Test and Measurement segment is another key area of focus, where it designs and manufactures products and systems to measure and control RF energy. The company offers a wide range of products and services, including turnkey systems, calibration and product tests, and proprietary measurement software. The company distributes its products through various channels, including distributors, sales representatives, direct sales teams, and in-house sales personnel. With a presence since 1990, Esco Technologies Inc. has established itself as a reliable provider of engineered components and systems to the aerospace, defense, industrial, and utility sectors. Esco Technologies Inc.'s stock price has seen a significant increase of over 62.89% in the past year, reaching an all-time high closing price of $268.94 on February 9, 2026. This surge can be attributed to several key news events. The company's robust first-quarter fiscal 2026 earnings report was a major contributor to this increase. Esco Technologies reported adjusted earnings per share, EPS, of $1.64 for the quarter, a 73% year-over-year increase that surpassed analyst estimates. Sales also rose 35% to $289.7 million. In addition to strong earnings, the company achieved a record quarter for orders, booking over $550 million, which represents a 143% increase over the prior year. This surge in orders led to a record backlog of $1.4 billion, providing strong revenue visibility for the future. The management's decision to raise full-year guidance was also a significant factor in the stock price increase. The company raised its adjusted EPS guidance to a range of $7.90 to $8.15, representing 31% to 35% growth, and increased the full-year revenue outlook by $20 million to a new range of $1.29 billion to $1.33 billion. The contribution from the maritime acquisition and segment growth also played a crucial role in the company's performance. The aerospace and defense (A&D) segment saw orders increase by 411% and sales rise by 76%, while the test business experienced a robust start to the year. Esco Technologies Inc. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Esco Technologies Inc. trades at a higher price-to-earnings ratio of 56 times and a higher price-to-book ratio of 4.46 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth in the company can be attributed to several key areas. In the A&D segment, commercial customer type revenue saw a significant increase of $41.2 million, while Navy revenues and aerospace revenues also experienced growth. The maritime sector contributed an additional $50.6 million to revenue growth. Additionally, the test segment witnessed a 28% increase in commercial customer type revenue, driven by higher sales from U.S. and European operations. The USG segment was another major contributor to revenue growth, with commercial customer type revenue increasing by a staggering $1.46 billion. This substantial growth was a significant factor in the company's overall revenue increase of $75.1 million, representing a 35% rise from the previous year. On the other hand, government customer type revenue declined significantly in both the A&D and USG segments, resulting in a notable decrease in these areas. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes between 2024 and 2025. Net income has increased substantially, rising by 22% from $23,473 to $28,691, and further increasing by 36.7% from $28,054,000 to $38,358,000. However, profit margins have not followed the same trend. The gross profit margin decreased by 0.5%, while the operating profit margin remained relatively stable at -12.2%. On a more positive note, the A&D segment's profit margins increased from 21.3% to 26.4%, and the test segment's profit margins rose from 9.6% to 13.8%. The USG segment's profit margins decreased from 23.6% to 22.3%. The increase in net income and profit margins can be attributed to various factors, including higher sales volumes, favorable mix, and price increases. However, these gains were partially offset by inflationary pressures and restructuring charges. The company's financial performance indicates a positive trend in its operating cash flow. According to the data, the net cash provided by operating activities from continuing operations has been consistently high, reaching $68,861 in 2025 and $68.9 million in the first quarter of 2026. This suggests that the company is generating sufficient cash from its core business operations to meet its financial obligations and invest in growth initiatives. The fact that operating leases and finance leases are not relevant to determining overall operating cash flow further supports this conclusion, as it implies that the company's cash generation is not being artificially inflated by these non-core activities. Overall, the data suggests that the company is generating positive operating cash flow, which is a key indicator of its financial health and stability. The company's debt level has undergone significant changes over the past period. Notably, total debt decreased by $40,489,000, indicating a reduction in overall financial obligations. Furthermore, long-term debt also saw a substantial decrease from $186 million to $145,511,000. However, current maturities of long-term debt and short-term borrowings remained relatively stable. In contrast, interest expenses have shown an increase. Despite some inconsistencies in reporting across different pages, the available data suggests that interest expenses have risen by $623,000. This slight increase is also reflected in the net interest expense figures for 2025 and 2024, which stand at $2,880 and $2,257 respectively. The performance of various segments and regions in the company has been a subject of interest. On a positive note, the A&D segment has shown impressive results, with the maritime division within it also performing exceptionally well. This is evident from the data presented on pages 8 and 15. On the other hand, some segments have struggled to keep pace. The USG segment has been underperforming, as indicated by the data on pages 8 and 15. Additionally, the test segment has also faced challenges, with its performance being a concern. The disparity in performance across different segments highlights areas that require attention and improvement. While the A&D segment is thriving, the USG and test segments need to be addressed to ensure overall growth and success. Concerns have been raised regarding the inventory buildup and potential supply chain disruptions in recent operations. A notable instance of inventory buildup was observed, with total inventories increasing by $9.346 million, 4.3% increase, as highlighted on page 6. Furthermore, there is a specific concern about supply chain disruption, explicitly stated on page 18, where it is noted that supply chain disruptions, yes. This indicates a potential issue that needs to be addressed to prevent any adverse effects on the overall operations and productivity. That concludes the financial summary for Esco Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.